Hi everyone, I am Mctricia and I am from Group 8. So this is our title, The Relationship Between Net Working Capital and Financial Performance from Consumer Products and Services Sector in Malaysia. And this is our members, Esther Ting, Britney Maria, me, Mctricia, Ubeintiraa Subramaniam, and Mohamad Shahidan. So I will present the chapter 1, which is the introduction. So this research is to investigate the relationship between net working capital and financial performance from consumer products and services sector in Malaysia. This research also will discuss about the problem statement regarding on the relationship between net working capital on financial performance. For background of study, this research study will mainly focus on the explanation of net working capital and financial performance. So, net working capital is a liquidity statistic that measures a company's ability to pay off current creditors with current assets. This ratio is important to management, vendors, and general creditors since it demonstrates the firm's short-term liquidity and ability to use its assets effectively. The formula of net working capital is by deducting current liabilities from current assets. If a company's current assets are insufficient to cover its current liabilities, it will be compelled to pay off its current debts using long-term assets or revenue assets. This can result in a reduction in operations and sales as well as an indication of more serious organizational and financial. And for financial performance, it refers to a metric that measures whether a company is able to generate revenue from its assets and meet its obligations to its shareholders. Financial ratios are essential indicators of a company's ability to earn profits above the cost of capital while still meeting its financial responsibilities to shareholders. Financial performance is important to investors, but it is also important to managers. Managers use this data to make decisions about how to manage a company's assets. So, financial performance data is used by analysts to project future earnings and growth. It is also used by lenders to determine if a firm is creditworthy. Moving on to the problem statement. The present cash and loan constraints threaten the existence of several companies worldwide, namely in Malaysia. Working capital management involves critical judgments on various areas, including account payable and account receivables. The key aim is to ensure that the company can continue to operate with sufficient cash flow. Boss Caballero et al. Demonstrated for the first time that there is a non-linear link between working capital and business success. This indicates that optimal working capital investment exists and corporate earnings are maximized. These findings have major practical implications as financial managers strive to maintain track of and improve their working capital on a regular basis.
As predicted and supported by some later research, there is a major literature imbalance in confirming the prevalence of this impact across a variety of firms and market systems. To the researcher knowledge, no study was expressly designed to investigate these nonlinear relationships for either rising nations or the consumer product industry. This research seeks to address this divergence by responding to the questions that includes what are the implications on profitability and return on equity of the net working capital. The study also analyzes the potential interactions, cash levels, and the implications on net working capital and profitability corrections. Next, research questions. The research questions of the study are as follows. The first one, what is the effect of net working capital on return on assets? The second one, what is the effect of net working capital on return on equity? And the last one is what is the effect of cash level on net working capital and profitability? Next, research objective. The first one is general objectives. To investigate the relationship of net working capital on financial performance from consumer products and services sector in Malaysia. Next, specific objectives. The first one is to investigate the relationship between net working capital and return on asset. The second one, to examine the relationship between net working capital and return on equity. And the last one is to assess the relationship between net working capital, profitability, and cash level. Scope of study. This study conducted across Malaysia, but the main focus will fall on the consumer products and services sectors. The data will be collected across Malaysia to get a larger overview of the study issue and minimize dropouts. Collecting data from companies' annual financial reports from the consumer products and services sector via an online platform. Lastly, return on assets, return on equity, firm size, leverage, sales, growth, and cash level will be the main highlights of the data collecting. Lastly, the chapter summary. The main problems of the study include what is the effect of net working capital or return on asset and return on equity, and what is the effect of cash level on net working capital and profitability. A brief explanation of the scope, which includes the scope of coverage and the scope of data, are written precisely in order to give the readers a clear picture of how the studies will be conducted.
Hello, I'm Esther and I'll be presenting for Chapter 2 Literature. So the first story for this study is Working Capital Management Theory. This theory emphasizes funding working capital into short-term financing, but this is not witnessed empirically, said a study. It outlines how working capital should be handled and illustrates the benefit of the company's right management of working capital, liquidity, solvency, effectiveness, profitability, and shareholder assets optimization. So we want to say that companies who have an effective WCM are the leaders in their field. And analysts appear to use working capital management of corporations when determined 1 year ahead of the gold price, according to Dole et al. In 2009. To continue, WCM is focused to improve the effectiveness of a company's short-term capital. So, for example, current asset and current liability are two types of short-term capital that business employ to conduct their day-to-day operation. And also, the thing to determine WCM is what we call CCC, cash conversion cycle. To keep monitor of their working capital represent the time between a company pays cash to its supplier and when it receives receivable from consumer. The positive impact of this theory is that larger inventories can eventually lower supply costs, protect from rising material costs that we cannot predict, and eliminate the operational interruptions and stock outs to provide entrepreneurial possibility. And secondly, it gives credit for trade and has a good impact on a company's sales since it may operate as a price reduction, a guarantee of product quality, and foster long-term client. But the negative impact showed by study by Meta in 2014 for the UAE real estate and construction market, and also another study that used the net working capital measure and the firm's profitability to test for nonlinearity in the connections between WCM and profitability. These two studies shows a negative. So theory number 2, which is profitability proxies. And this study measure the net working capital and firm performance using ROA, which is return on assets. And return on asset is important in evaluating a manager's performance since it evaluates the effectiveness of the firm's management. And ROE, on the other hand, is also important to another stakeholder, which is investors. The study also employ ROE, return on equity, uh,
because we believe that liquidity management has an impact on the firm's debt structure, since it includes the management of assets and liabilities in uh, this study. And therefore, this study separates the effect of asset management and financing on the profitability by utilizing both measurements as our. The third thing being important in our literature review is the investment in working capital and cash holding level. Kim et al. Said that liquid assets have low returns and increase the taxation. Jensen explained that excessive cash holdings exacerbate agency issues. And trade-off theory explained that funds should aim for a cash level that is efficient in both maximum benefits and the cost of cash return. In the time of crisis, Suruta used a quarterly firm level data of listed Japanese firms to find that during crisis, working capital modifications were more limited, and because cash can play a role in working capital and the corporate performance link. And this study shows that there is a negative association between excess working capital and company performance. It grew much stronger, especially. So, what is in it for small businesses? Small businesses should maintain more cash than their larger peers because their operating and financial risks are higher. Enterprises with higher credit ratings and therefore it holds a greater capacity to raise capital from debt and equity markets compared to the small businesses. And firms with lower credit ratings thus have a better ability to borrow and retain. So, to sum up the three things that I explained just now, if a company can produce more cash from their operation and transform their working capital into cash quickly, it should have less cash on hand. And working capital is mostly pushed to positive values by cash assets, which are inventory, accounts receivable, and accounts payable, rather than non-cash asset, which. So to sum up the three things that I explained earlier, if a company can produce more cash from their operation and transform working capital into cash quickly, it should have less cash on hand. And working capital is mostly pushed to positive values by cash assets rather than non-cash assets. When a company has both positive net working capital and positive cash holding position, this may happen due to the lack of capacity to convert non-cash working capital asset to cash rapidly, and this can increase business risk. And also, while positive working capital level may have a great impact on their firm's profitability, positive cash level are likely to exacerbate the negative association between positive working capital and profitability is steeper when it is positive.
2.4 Theoretical Framework. Independent variables, net working capital, control variables, firm size, leverage, cash flow, and sales growth. Dependent variables are ROA, return on asset, and ROE, return on equity. Hypothesis development. So the researcher would like to study the relationship between the dependent variable, independent variable, and the control variables, net working capital, and profitability. To explore the probable linear relationship, researcher separated sample into two groups, which is a positive and negative, and postulated the following. H1, net working capital has a non-linear effect on profitability. H2, if a firm's net working capital is positive, statistically negative effect on NWC on profitability. H3, if a firm's NWC is negative, statistically positive effect on NWC on profitability. Cash holding level. Researchers separated the companies into two subgroups based on cash holding levels, positive and negative, using cash levels at their control variables, hypothesizing the following. HA. If a firm's NWC is positive, which is net working capital, the negative effect of its NWC on profitability will significantly differ based on the cash level, positive or negative. HS. If a firm's NWC is negative, the positive effect on NWC on profitability will significantly differ based on the cash level, positive or negative. The cash level rate is derived by subtracting cash and cash equivalents from contractual liabilities. So let's summarize this chapter. This chapter covers on reviewing the journals which has been previously conducted by other researchers. Each researcher has their own strong argument to support their own result. The factors that impact the dependent variables are net working capital. Most of the previous studies have a common finding whereby these variables affect profitability among the businesses. Basically, the previous studies are conducted on a different countries, and the sector which the researcher tends to find the concrete view on how the net working capital affected the profitability. Theory related to this study are included in this chapter to support and embrace the topic as one of the concerning issues in consumer product and services sector. The theory is working capital management theory. This theory is brought up mostly to analyze the net working capital on the businesses. The common thing in this theory is trying to seek for the clear reason of the financial performance.
My name is Mohamad Shahidan, and I will explain the methodology part. So, first of all is the research designs. Our research using a quantitative analysis, and the data will be gathered from a secondary data. And also we focus on a non-probability sampling, which we are selectively identify which companies are suitable for our research. Moving on to data collection, so our research samples comprise approximately of 150 companies from the consumer products and services sector in Malaysia, which poses mature stock markets to better support the role of equity and profitability. And the sample period is determined to be taken from 2015 until 2020. Next is dependent variables. So we just have two dependent variables, which is the return on assets and return on equity. So the ROA is the earning before interest and tax divided by total assets. It is a profitability proxy that is generated using EBIT to reflect the firm's net operational profits while avoiding the country non-homogeneous interest and tax rates. And second is the return on equity, which is the net income divided by total shareholders' equity. It shows a more investor-focused profitability metric that reflects the corporation's financing strategy. Independent variables. So our independent variable is the net working capital. It is inventories plus debt receivable minus trade payables divided by sales. It is the aggregate amount of all current assets and current liabilities. It is used to measure the short-term liquidity of a company. It can also be used to obtain a general impression of the ability of company management to utilize assets in an efficient manner. To meet the requirement of the research objective, we also include the control variables. The first one is the firm size. It is a natural logarithm of total assets, leverage, the total liabilities divided by total assets, the sales growth, the sales current year minus by sales past year divided by sales past year. And last but not least is the cash level. It is the cash and cash equivalents divided by sales. Furthermore, this is the estimation models. So we are using 3 models in our research. This slide shows the variables used in the models, so you guys can see this slide as a reference. Data analysis. So our research using a panel data regression. So 4 tests is used in our research. The first one is normality test. second, multicollinearity test, third, heteroscedasticity test, and fourth is autocorrelation test. So that's all from us. If you have any questions, feel free to ask in the WhatsApp group and we will answer it in the next class. Thank you.